So welcome again to Dollars Making Sense, weekly video and broadcast with Ray Trevisan and Henry Jennings. And again, thank you very kindly for those of you that have tuned in or watched and may end up starting listening very, very soon. So thank you for that. For those of you on YouTube, please check out our subscribe button down the bottom corner of the screen and hit that subscribe button so that you get notified each and every week of our channel updates. So again, thanks very kindly for feedback. We're starting to get some good feedback. Some of my listeners and contributors at the AIA discussion groups are starting to watch, so that's really very heartening. So again, just to explain what we're doing with the YouTube channel, this forms the core of a radio program that we do on Radio Northern Beaches, and we'll also then be we'll be then producing this into a podcast as well. So don't forget our socials. We're on Facebook. We have Dollars Making Sense Facebook page. Again, your questions are welcomed, and you can also comment at YouTube. So please, bring in your comments and questions, and we'll talk a bit about that later on as well. So Henry, over to you. How's your week been?
It's been good. It's been good. I was down in Melbourne last week at a MicroCap conference, which is always really interesting, and to see what else is out there. And it's always kind of exciting to see small cap stocks that are trying to become big cap stocks. They're always very ambitious. They've always got pretty cool technology. So it's a good hunting ground for investors looking for growth. Certainly there were a lot of people there. It's a very professional conference, good quality of presenters, good quality of companies. So no, it was a good few days down there.
So do you see the odd occasional new Atlassian coming around the corner there?
Haven't seen any Atlassians yet, but then I still haven't quite worked out what Atlassian do. So if I saw one, I probably wouldn't even recognise it. But what there was this year, certainly there was a very big focus on life sciences and biotechs, which is unusual. Usually it's tech stuff in the IT sector or some sort of disruptive technology. But this was there were a lot of life science companies there, which was good. And considering some of the gains that have been made this year in the life science side of things, probably not completely unexpected.
Okay, I'm going to ask the dumb question. What do you mean by life science? So specifically, what kind of product might they put out?
Biotechs, treatments, cures, medical devices, pretty much up and coming drug companies looking at some treatments for orphan drug status. Orphan drug usually means that the disease is so bad that it's going to get you. So you get a lot more latitude in terms of how you can test, because the downside is not that great. You're going to die anyway, so you might as well try it.
So you've got a lot of guinea pigs, I guess, to use. So
well, they're not so much lots, because they tend to be very specific conditions, which may not be a huge market for. But it's certainly, if you can prove up your technology in these really tough conditions, then sometimes that can translate into other forms of cancer, other treatments as well. So a lot of that, and medical devices as well, in terms of I saw one company down there last week that was involved in microwave technology to analyze brain injuries, strokes in particular.
And do these companies do they still have to go through the rather strenuous FDA type of regimes? Because that can be anywhere between a 5, 10 or even 15-year process.
It's a long process. Phase 1, 2, 3, they have to prove that it doesn't kill you first, and they have to prove that it does actually work, and then once they prove that it works in a small sample, then they have to go to a big sample. So it does take time, takes money. Usually once they get to various different stages, they can get collaborators come in, do the funding, because by the time they get to phase 3, that is expensive, because you're talking about large studies with large numbers of people. Sometimes if it's technology based, it's a simpler process in some respects, because like this one, Technology, EMV, it's pretty much it's a big motorbike helmet that goes on your head, attached to a machine and some smart software, AI, and that analyzes your brain to make sure that things are going well in terms of stroke treatment and recovery.
Okay, good. And do you see some potential gains there in the area of, say, things like Alzheimer's? There's some interesting upshots in that space as well?
Yeah, I mean, I think there is, and there's a lot of people out there trying to work on these big diseases. And of course, you look at the US market for the drug, it's just, it's crazy in terms of the amount of money they spend. I think, looking at I don't know whether we talked about this last week, but there's a cold sore cream that everyone uses, WAAAX, I think it's called, and I think it's $14.99 in Australia. So you can get a tube of that down your chemist. It's 2 grams, $14.99. In the US, it's $186 US a gram.
Wow.
For the same stuff.
Why is it such a big price disparity?
Because it's the US, and the drug companies there, it's a generic drug. It's a generic treatment. It's the same treatment, and they charge the drug prices there are astronomical. That's why their health system is completely out of control. But that's also why companies target FDA approval, because it is the promised land.
It gets access to that very large marketplace.
Because
yes.
You've got a massive market, massively overpriced market as well. So it is very tempting for these companies to be focusing on that.
Okay, so last week we talked about WiseTech, and for those that are not necessarily in favour with some of the terminology, WiseTech forms the W in the WAAAX groups of the WAAAX group of companies, and WiseTech is the W of WAAAX. So WiseTech, Appen, Afterpay, Alteon, and Xero. And why is that so topical? Because these WAAAX companies, again, have been quite... they've been the darlings of the stock market here locally for quite a while, haven't they?
They have. They're our equivalent of the FANGs, which are the US...
Facebook, Alphabet, Netflix, Apple and Google, that's right.
So the FANGs in the US have been one of the big drivers, the big tech sector drivers. And of course, we want to imitate the US, so we have to come up with our own group of stocks and our own an acronym for those stocks. So it was called WAAAX. It's a shame that Kogan wasn't in there as well, but we'll get to that. But the group of stocks, they're high PE stocks, they're high growth stocks, and they've certainly, some of them are world beating technology in terms of Appen. Very much so. Appen in theory has, I think it's 1 million employees effectively around the world. They subcontract out the data side of things to 1 million people around the world that analyse data and help in terms of voice recognition software and stuff like that. So these are global companies. Xero, probably not so global, very well known here as an accounting software package. Big strides, trying to make big strides in the States, but they do have serious competition over there. In the States from a local provider.
That'd be the Intuits and the like, so the QuickBooks and
all those
sorts
of guys. So.
But it's still a decent market to go after, and
it's a big market, and it's a viral market for someone like Xero. It's a viral market. Once you've got a convert to the platform, it's hard to go back.
I'm one of them, I must admit. I was an MYOB user for 15, 16 years, and the moment I went on to Xero, I was an instant convert myself.
And tell your friends.
And I end up doing that because, I have a business, I run contractors, and with single touch pay now being mandatory, it's just one of those things. And I really believe they have been eating MYOB's lunch now for quite a number of years. But interestingly, when we look at the 5 WAAAX companies I've got here, WiseTech are trading at a PE of 156, according to the latest stats I've got here. Appen are at 33. Afterpay nil because they're still not making money. Alteon's at 60, and Xero's in the same boat. They're still not making money. So what's your view on these? Do you still see that future being there for them?
It's a very bright and rosy future if you believe the growth profiles of these companies, but they're expensive. I mean, they're not cheap, and they do have to produce the goodies at the end of the day. And if they stumble, if they fall, those ratings can be very quickly cut.
Just like we've seen with WiseTech and J Capital, as we were talking about last week.
Just like we've seen with WiseTech. So, WiseTech is a classic case there. It's been under attack from a aggressive short selling research fund, and there was a bizarre interview last week that the CEO gave. Absolutely bizarre. If you haven't seen a train wreck of a corporate interview, I suggest that's one to go and look at on the ABC catch up, because it is extraordinary.
In what way? Please illuminate us.
Well, the guy's the CEO and the founder, and there were a number of questions that, one, he couldn't answer. Secondly, there was a voice coming from the other side of the room which was answering questions not on camera, which was bizarre.
Look the other way.
Which was completely and utterly bizarre.
Wow.
So it was a very strange interview. In theory, a one-on-one between Elise Morgan and Richard White, and there was a off-camera voice that can be clearly heard.
Was this live?
They must have done it. They must have recorded it. They usually recorded those interviews because I've done interviews with Elise. They usually recorded and then they're put to air. But the ABC obviously decided that, you know what?
This was newsworthy, I guess. My word.
It was
but I
bizarre.
mean, you expect a CEO to have a good grasp on their company and their P&L, one would hope.
Well, he's not just the CEO. He's the founder. You would expect the guy that conceived this business, built this business, and is the CEO of this business, would have a very good grasp of things. And, you know, it's okay if a CEO comes in and he's been in a job a month and he's still getting his head around things and they've just called him on the hop about some really intricate taxation issue.
Right.
Fine, I'll cop that one. But for a founder to be struggling, especially given the circumstances surrounding the interview, he must have known that the sort of questions that were coming and should have been better prepared by his advisors or actually known the stuff himself.
Sounds like the advisors were in the wings yelling.
Well,
throwing bits of paper planes with them as well.
That certainly was kind of the influence, is that
Wow.
there was somebody in the wings and there was this voice off camera. So bizarre. I urge you to go and see it if you want to see a corporate train wreck interview.
Well, I mean, we saw a similar one with the acting White House Chief of Staff dobbing his boss in pretty badly,
Yeah.
and then having to retract. I mean, we're used to train wreck type interviews, and I think nothing's abnormal. You know, the new normal is abnormal. Even today, with the announcement overnight of the terrorist Baghdadi being taken out, I don't think I've ever seen a press interview of the likes, and even, you know, old stalwarts like Dan Rather, who has been in the game a long time, were really quite taken aback by this current president and,
right.
and the just the whole posturing. I think it's really quite astounding. And in the world that we live in now of 24/7 comms, one would think a CEO would turn up for a pretty important interview that really, you know, investors are looking to, because they're looking for guidance. That's what they look for, don't they?
If you're going to steady the ship and you're going to give an interview to the ABC business program with Elise, you want to be on top of it.
You'd expect so, wouldn't you?
That's what you get paid. So. That's why, you know, the bloke's worth $4 billion.
Wow.
You would think he would have got it right.
Wow. Okay, so let's move on. Last week we talked about reporting season, and you were going to cover off banking stocks.
Banking stocks, yes. Well, we got the banks coming up for reporting. The first one kicks off, I think ANZ kick off on Thursday.
Uh-huh.
And then we've got the sort of odd one out a little bit is Macquarie on Friday. So that's not really part of the big four, obviously. And then we've got NABS and Westpac next week. So it's going to be interesting. Collectively, between the three of them, they're going to report around $18.5, $19 billion in profits, which is no small amount of money. If you add in CommBank, you're looking at close to $30 billion still for these four banks. That's not even including Macquarie as number 5.
Right.
So that is an awful lot of money. So the expectation is obviously the banks will not be crowing about this because politically it's pretty unsound to do that in today's.
But they'll be gnashing their teeth, saying how hard conditions are, and, you know, we've struggled to get to this profit.
There will be some gnashing of teeth, and I suspect that shareholders will be sharing the pain of the remediation costs that the banks have suffered in terms of dividend cuts, and we may see ANZ certainly may be cutting their dividend. That's certainly the forecast in the market. Same with Westpac potentially and NABS potentially as well. So investors who have got used to this very generous largesse on behalf of the banks in terms of their dividend,
and the government with the franking
let's
credits.
not go down that route. Hi, Jeff.
But it is still a tax rebate. Let's not, you know, mince words here.
Well, it's not a tax rebate because this is money they haven't paid tax on. If you go to
but it's a check. They get a check.
Yeah. So, but it's not.
They get a check.
It's a cash rebate. anyway.
Even better still for those that can get it.
For those that can get it, it's a fantastic little number, and obviously...
And everyone else is paying for it
here to
along
stay,
the
so
way.
I'm happy to be paying for your retirement. Thanks very much for that. Looking forward to my own.
I'll probably cut it out by the time we get there, but that's another story.
Yeah.
We'll wait and see.
But yeah, certainly these results are going to be very much poured over, and they will set the tone for where the ASX 200 goes between now and probably Christmas as we get those checks.
To give the viewers and listeners a bit of a feel, when you're talking about, let's say, those 5 banking stocks, MAC and the big 4, what kind of percentage of the ASX do they soak up?
Around 25-30%.
So it's a big chunk.
It's a big chunk. It is a big chunk. It is also, they're a political football, and we've even seen in the papers today that Treasury, this came out under Freedom of Information, have been urging the RBA to lend money to the banks at much lower rates so they can make more money, because their margins are under pressure because of low interest rates, which is what the banks have been squealing about, whereas Scott Morrison and Josh Frydenberg, who are in charge of the Treasury Department, have been saying that banks are making off like bandits in this current low interest rate environment because they're not cutting rates to the same extent that the RBA does. I think Scott has to, and Josh has to do a bit of economics 101 here, because eventually the interest rate margin will be squished, because you can't cut deposit rates.
This is the NIM we were talking about.
This is the net interest margin. This is the difference between what the banks pay for their money through either deposits or through wholesale funding routes through US or European markets or local markets. So this is what the banks pay for their money, and this is what the banks get on the other side by lending that money out. And at the moment, that net interest margin has been falling and is under pressure, and that's how these guys make money. And if you look at, I know it's hard to look at a sector and say it's struggling with 19 billions in profit to come in just these 3 alone, but it certainly is under pressure. What with remediation costs, higher regulatory hurdles to jump over, more legal fees. The good thing they've got going for them, of course, is the housing market is starting to accelerate. Downturn, what downturn? You had to be quick. It's now accelerating out of control again.
Well, that's because of the lack of stock as well.
And there is
talked about last week.
There is a lack of stock around, so that is helping stoke the market. And of course, what also helps stoke the market is the media, who do a really good job. Sydney Morning Herald has on their online page, they have more dedicated to, I think, news in property than they do actually probably about news around the world.
It's that old quandary of the barbecue conversation in a Sydney backyard is just about always about the price of the chunk of land you're living on.
Yeah, it's funny, isn't it? I've been to lots of barbecues and I've never had that conversation.
Well,
I must be going to the wrong barbecues.
I must be as well, because I read about it all the time. And again, when you see about how much coverage, you're right, the column inches that are taken up in the Sunday paper, and again that median, that indicator that I like to follow on clearance rates, for example, to me is a good indicator of the bullishness of the market, but also a great indicator of are people actually outselling, because it's spring at the moment. The weather's starting.
Spring
to
has sprung.
up. And so, this is the time when people are supposedly, according to agents, saying, okay, now's the good time to be selling.
Yeah.
Because your house will be in its best nick. But again, I guess from the banking stocks, though, for the people that are the big investors in the banking stocks, and I now refer to, for example, SMSF trustees, mums and dads and the like, do they have good news to be looking forward to?
No, they don't. But what they don't have is bad news. So bad news is probably good news in some respects, and I don't think we are going to see what I think is the danger with the banking stocks is that we get this drip feed of remediation costs and ongoing IT issues and and it just goes on for years and it wears you down. It becomes like a cancer in the sector, and there's so much uncertainty out there that people can't invest on a certain basis. What you need to know, what is great about the investing landscape, is if you can make certain of the outlook, then you can plan for that outlook. And if we think of the banks as that they have slowed, they've taken all the costs, and now it's back to not business as usual, because clearly it's not business as usual. But if we look at the dividends going out for the next 2, 3, 5 years, which is what people are concerned about, you can see a trajectory that is slightly more up than down. And I think that will be enough if there's no bad news, that will be enough to go, you know what, okay, dividends are cut, but it's still 5.5% fully franked yield instead of 5.7% fully franked yield. Am I going to quibble about the 0.2? And where am I going to go to get it if I don't?
But can I double back on something you mentioned earlier about the government stepping in and asking the RBA to lend more money?
No, not the government. The Treasury.
But
that's
they
a very
are
different beast.
Defacto.
No, that's a different beast. The Treasury.
So that's not Frydenberg. That's now
the Treasury advises Frydenberg.
Right.
So the Treasury is supposedly independent, bunch of bureaucrats that they run the economy. But these guys are the guys that comes up with forecasts and put things to the minister, and the minister says yes or no. So they're suggesting that the banks should be allowed to access low interest rate loans from the RBA to enhance their net interest margin.
Yeah.
Whereas Josh Frydenberg and Scott Morrison have been saying, no, you're naughty people because you're profiteering from this high net interest margin.
But can I remind you, I think early in this particular iteration of government's tenure, they loaned the RBA at some stage 10 billion. You know, they added that straight onto the country's credit card bill. So, you know, they were whining about Labor's debt, but they were more than happy to put themselves 10 billion more in debt. And this is a couple of years back.
I think that was a contingency. That was under Hockey.
It was Joe Hockey.
It was Joe Hockey who slapped a quick 10 bill in the RBA just to shore up their balance sheet.
And so we're all scratching our heads going, budget emergency? What budget emergency? We can write another check for 10 billion and just walk away.
Yeah. I think the RBA paid a dividend back to the government last year of 5 billion. So that's not a bad little in the skyrocket, because the RBA effectively is the ultimate insider. These guys can make money out of the foreign exchange market. Bearing in mind they dictate policy and dictate interest rates and dictate what they say to the public.
So they're the ultimate bookie, aren't they?
They do. They are the house. They run the house. They are the house. They bet against everybody else. So they do quite well.
I'm interested as well when we're talking about banking stocks. One of the banks that I see advertising online, for example, with some of the on-demand services that I watch, and they call themselves the fifth bank. It's not Macquarie that I'm talking about now.
No.
I'm talking about Bendigo Bank.
Yeah.
Do you have a comment to make about them and their prospects in comparison to the high street banks?
Yeah, I'm not a fan.
Tell me more.
It's a highly competitive world out there. It's very expensive to produce world-class systems, IT systems. A lot of the big banks have legacy issues in terms of their computing systems. They've been patching them up, putting patches over them year after year after year.
A lot of them are still running old Windows versions that should have been retired 15 years ago.
And it is a competitive world, and if you're competing for the average home loan borrower, it's hard if you're the fifth wheel to get it into the big four that are going to be competing very much on price. They've got scale, they've got serviceability. I just think that the regional banks, that's Bendigo and Adelaide and Bank of Queensland, suffer. Apart from the fact the markets they're lending into, Queensland and rural and regional Australia, in some cases in Victoria, that's their key kind of loyal demographics. They're not experiencing Sydney and Melbourne rushes of adrenaline. So I think it's hard for them. It's hard for them to attract quality management. You know, if you're any good, you're working for NAB, CBA, or Westpac or ANZ.
Yeah, it's a good point.
If you're a really good IT expert, you're going to be working for CBA. If you're a really good risk manager, you're going to be working for NABs. So they tend to be second tier in so many ways. And when the big boys are fighting for market share, the little boys, I think, get hurt.
They get squeezed. Interesting. But I mean, one of the things that I note with interest talking about banks is that, you know, one of their big value adds was the branch network. You know, that they were able to claim this very wide and expensive branch network. But here we are on Sydney's northern beaches, and my own bank is closing my own local branch, and I'm going to have to say goodbye to people that I've been doing business with for 20 plus years. And, you know, I've got to drive 10, 15 minutes down the road now if I want to do a branch transaction.
I mean, I can't remember the last time I walked into a bank to do anything.
A lot of people don't. But again, in the nature of what I do, for example, I need to actually do transactions, not often, but now I'm going to be stuck with having to schlep over to Mona Vale, whereas before I could just wander on down to my local village. And again, people would like to think that a bank is still that nice, friendly, that old reminiscent times of when we actually had bank managers and we had relationships with bank managers, but that's long gone, isn't it?
I had one from the age of about 16 called Mr. Thorpe, who was very good for me in Barclays in the UK and was very good at extending overdraft facilities when I was a younger man and arranging mortgages and things. But those days, forget it.
They're gone, aren't they?
Gone to God.
Just like the buggy whip.
Just like the buggy whip. And, this is the problem for the Bendigos and Adelaide's, the Bank of Queensland. There's a whole generation of kids that are growing up who are now using fintechs. Everything is on their phone. Mm-hmm. There's a whole new generation of neo lenders out there, and the business they're going to steal is not necessarily CBA or NABS or Westpac or ANZ. It is going to be Bendigos and Bank of Queensland, because they just can't. They're kind of stuck between the devil and the deep blue sea. They're too big to be nimble and too small to really get those kind of economies of IT scale or quality management.
So last week we talked a little bit about Defacto bond type investments, and one of the clippings that I took from my reading during the past week was this one that caught my eye: SMSFs taking unnecessary risks on banks. And again, SMSF investors who are overweight in banking stocks for income generation purposes, just like we were talking about, to be able to get dividends. And the number of times I come across investors who go, I'm diversified, Ray. I have every bank, not just one. I've got them all. And
cover all the bases.
In that regards, let's just maybe double back a little bit about what we talked about with regards to infrastructure assets. And I'd like to maybe, again, pinpoint discussions we had last week around Sydney Airport and say other monopoly asset type plays.
There are, I guess, a bunch of monopoly asset type plays, especially in the infrastructure space. Sydney Airport clearly
is a good one.
Is a good one. I mean, I think they make $186,000 profit a day out of the car park.
It's amazing, isn't it?
Yep.
Absolutely amazing.
And it seems it's always me that gets the 180. It seems me I'm paying for it.
I always seem to be able to go just the number of minutes over to be able to go to the next increment, which jumps from 5 up to 19.
Yep.
And I'm just sitting there going, they must do special technology audits to be able to say, okay, they normally stay that much, so let's cut the $5 right back to here, and they're always going to go over it. Because, man, likewise, I'm always paying a lot to park down that.
And it's not just parking. You eat there. I mean, I was heading down to Melbourne last week, and I think I got a coffee and a muffin. It was $12, $13, and you just think, really?
Chew slowly.
It wasn't even that good a muffin.
Okay, so Sydney Airport.
So Sydney Airport's one, of course. The big, that is the big daddy of the beep society. Because when you go past that tag goes beep and you don't even feel the pain anymore. When they first started out, the other day I was driving back from the Eastern Distributor on the way back from the airport, and I remember when that toll first came out, it was $3.50, and it wasn't that long ago. The Eastern Distributor, for those of us who are slightly older and the older generation, it is now $7.76.
Yeah, it's about $7, and always these odd numbers. Why are they these odd numbers?
Because basically the Transurban have got a mandated price rise every year. So they either get
good for some,
They either get CPI, which is low, or they get, I think it's around 3.5-4% mandated. So because they can go beep, you don't have to fiddle around with change to pay $7.76. They don't round it down to 75 or up to 80. They can just charge.
They can take the increment.
They can take the increment, and that's what these guys do. And the power of compound interest is very, very powerful. And $3.50 to $7.76, and next year it will be $8.05, and next year it will be $8.50.
Can I also remind, though, this was the very piece of road that went bust.
No, not the Eastern Distributor.
The ED, or am I thinking the Cross City Tunnel now?
The Lane Cove Tunnel had issues, and the Cross City Tunnel had issues.
And are they profitable these days?
I think the Lane Cove Tunnel is. I'm not sure about the Cross City Tunnel.
I don't know.
Transurban don't own the Cross City
City
Tunnel.
Use it, that's for sure.
Well, that was the problem. An ill-conceived piece of infrastructure. But Transurban do control most of the toll roads in Sydney. They don't control the Harbour Bridge. and they do control most of the toll roads in Melbourne as well. So that is a monopoly infrastructure asset. The other one that's interesting in that space is APA, which is a pipeline business, and they control a monopoly asset of gas pipelines around the countryside. Have been subject to a number of takeover approaches from foreign investors looking for that guarantee of earnings. Have been knocked back on Foreign Investment Review Board constraints and national interest concerns.
Right.
But certainly that's up there. But there are a bunch of them. There's Auckland International Airport as well, AIA, which is thinly traded here, but it's still a monopoly asset in terms of...
So these are stocks that you certainly believe a longer play kind of investor should be looking at for dividends, for income, for capital growth?
They do provide a certainty of earnings. Although we're seeing a bit of a tail off in terms of tourist numbers coming into Sydney, and domestic tourism is on the nose a bit because of consumer sentiment, and we're also seeing a drop in Chinese tourism too. They do offer that long-term growth profile, and as such have been really popular with overseas pension funds who are trying to match assets to 30-year, 40-year cycles. And something like Transurban, they front load the business with all the debt to begin with. Because that's how it works. They financially structure it so all the debt's up front, and then gradually towards the end of the concession, all that debt will have been repaid and paid, and they will just be
generating
a lot of money.
Okay, so at this point, I'll just quickly go into our disclaimer. So thanks for listening to Dollars Making Sense, a weekly program about finance, money and investing. The views, comments and opinions aired during our program should not be construed or viewed as financial advice. Any commentary is general advice only and does not take into account your objectives, financial situation or needs. You should consider whether the advice is suitable for you and your personal circumstances, and if in doubt, you should contact an authorised, licensed financial planner. So, Henry, before we move on to buy, hold and sell for this week and round out, I just wanted to pick up, we'd been talking about WeWork for a couple of weeks, and this is the office space startup valued at $47 billion. As recently as January, and again, there's some salient lessons to be learned here, listeners, because this is a rescue package that's been brought out by SoftBank, a Japanese company, and it's now valued at $8 billion. And SoftBank have agreed to pay the founder and CEO Adam Neumann, good job if you can get it, an $185 million 4-year consulting contract, and to extend him another $500 million in debt, in a debt facility. And that sort of leaves him the opportunity to walk out the door. But not so good if you're an employee, because more than 90% of their employees' options are now underwater. And again, I keep on saying to people, if it looks too good, and this was definitely one of those floats that was in that area. And again, just to round out, it's also something you said last week, Henry, there's a lot of money in the market. And again, I just read this piece. The fuel for optimism, money, remains flush in the valley, and I mean Silicon Valley now. There is a lot of capital looking for a home. And this story about capital chasing yield and earnings that just aren't there, again, don't be fooled by all the hype and glory. Again, one of our listeners gave me some great feedback. The Henry Jennings Glossy Brochure Index. Okay, if the glossy brochure is there, buyer beware. So let's round out on a buy, hold and sell.
I recommended Praemium a few weeks ago.
Yes, I have that one, yes.
54 cents. They're currently around 66 cents.
PPS.AX, so that's been a rise of how much?
What's that, 20-25% or something?
That's not too bad at all.
That's not too bad. So that's doing all right. So I think that's still in the buy category there. CIM.AX is one that I think is certainly worth looking at. It's kind of thin. They're a contractor. They've won lots of contracts. Their results came out recently.
CIM.AX, and what's the ticker for that?
CIM is the code. They are majority owned by Spanish construction groups, so there's only around 28% free float. So that does mean that they tend to be quite volatile. But they announced their results, when was it, last week? And there was no real nasties in there, which I think people were concerned about. So I think they will continue to push higher. As far as sells go...
Is WiseTech on a sell, do you think, at this point, given the negative news about them?
Yeah, I do.
Okay,
I do.
so a sell for WiseTech?
I do, but it's... there's a lot of shorts out there, so it does have some periods of extreme volatility, both up and down, but I'm sort of going with the smoke and fire routine there.
So where there is smoke, you think?
I never really got the whole story to begin with. 33 acquisitions since listing. To me, that always smacked
we
of
talked at length about that last week. And
so
my own experience around acquisitions that has me running for the
so
exit
even
doors straight
before
away.
the short seller people attack the stock for the accounting, and I'm not an accountant, so I can't testify to the veracity or otherwise of the accounting treatments. But it just, there's something rotten in the state of Denmark, and it just, to me, I wouldn't be going near it unless I was a really, really short-term trader. But it's the sort of stock that you could go into suspense in the next 10 minutes and the company come out with a profit downgrade and go, actually, you know what, our auditors have had a look and things aren't as good as we thought, and the stock drops another 15%.
Yeah, it has a big crash.
Yeah, or it could come out and say, you know what, our auditors have had another look, and it looks fantastic, and it's up 15%.
Yep. Okay, so that rounds us out for this week, Henry. Again, thank you so kindly for your time.
It's a pleasure.
One of the things, again, I wanted to, again, in the readings, I'm a member of the Australian Institute of Company Directors, and they do a yearly sentiment index. Now, this is a survey of all its membership, and I think they've got something like 35,000 members, and this particular sentiment index had its highest percentage of people responding. So 1,500 for these directors and CEOs is actually a pretty good response. But they have come back and said that their sentiment, in other words, their feeling about the economy is the weakest reading since the second half of 2016. And when you combine that with the China marketplace now slowing to 6% annual pace, this is its slowest rate in about 3 decades. Now, albeit the Chinese economy is a heck of a lot bigger than what it used to be, and 6% is still a very, very healthy growth rate. So,
and yet here we are at all-time highs.
We're still at all-time highs. So we've got capital looking for a home. Equities tends to be that home. So again, may we live in interesting times. Henry, thanks very kindly.
My pleasure.
And thanks for watching Dollars Making Sense. Until next week.